When you get a loan from the bank, they don't just go into a vault, pull out someone else's savings, and hand it to you. They literally create the money by just typing numbers into a computer. This process is called credit creation, and banks are licensed by the government to do this. And once you understand how this process actually works, you'll understand why inflation happens, why the financial system collapsed in 2008, and why a savings account paying 0.5% interest every year isn't nearly as safe as it feels. So here's what happens when you actually walk into a bank and ask for a $10,000 loan. You sit down, you fill out an application, the bank checks your credit, verifies your income, and approves the loan. Then they open their computer and credit your account with $10,000. That's it. But that money didn't exist a moment ago. They didn't take it from someone else's savings. They didn't move it from a pile of reserves. The bank created it. Now here's the part that breaks most people's brains. On the bank's balance sheet, two things just happened at the exact same time. On one side, the bank now has your loan. You owe them $10,000 plus interest. That's an asset to the bank. On the other side, you now have $10,000 in your checkings account, and that's a liability to the bank. They owe you that money whenever you spend it. So with one keystroke, the bank created both an asset and a liability at the same time. Now you take that $10,000 and you pay the car dealership, and the car dealership deposits that money into their bank account. At this point, that deposit becomes part of the banking system, and it can now support more lending somewhere else in the economy. That's how one loan can lead to multiple rounds of money creation as the money moves from bank to bank. This process is often referred to as the money multiplier effect. Now, if this sounds crazy, you're not alone. Most people just think banks are intermediaries. There's something that savers put money in, and banks lend that money out to borrowers. That feels intuitive. It's what we're taught in school. It's how most people imagine banking works. But that's not what the Bank of England says happens, and it's not what the Federal Reserve says happens either. In 2014, the Bank of England published a paper explicitly stating that banks do not simply act as intermediaries, but that they actually create money. And this isn't some conspiracy theory, it's not some fringe idea, it's literally how the modern financial system works. So if banks can create money when they make loans, the obvious question is, why don't they just create infinite amounts of money? And there are basically four things stopping them. The first is capital requirements. Banks have to hold equity, real ownership capital, as a percentage of the loans they make. So if a bank has $100 in equity and the capital requirement is 10%, that bank can support up to about $1,000 in loans. And this is what actually limits lending in the modern banking system. Not reserves, but capital. And second is creditworthy borrowers. Banks can only make money if loans get repaid. That means they need borrowers with good credit, steady income, and collateral. If everyone is broke, over-leveraged, or risky, banks can't lend even if they want to. This is why during recessions, even when the Federal Reserve drops interest rates to zero, lending doesn't automatically pick up. Banks don't want to borrow if the future looks uncertain, and consumers don't want debt when they're worried about losing their jobs. And third is profitability. Banks make money on the spread. They might pay you 0.5% on your savings account to hold your money, and they charge 7% on a car loan. That difference is their profit. If that spread gets compressed, for example, if banks have to pay more for deposits but can't charge much more for loans, lending becomes less profitable. So banks do less of it. And fourth is something called interbank settlement. When you send $10,000 from your bank to someone at a different bank, the banks don't just adjust numbers internally. They settle that transaction using reserves held at the Federal Reserve. Your bank has to send $10,000 in reserves to the other bank. If it doesn't have enough reserves, it has to borrow them, either from another bank or directly from the Fed. And this is why banks still need reserves, not to back every deposit one-to-one, but to handle the day-to-day flow of money moving between banks. And to show you guys how money creation works, let's look at a simple example. Imagine you deposit $100 in Bank A. That's a real deposit. Historically, banks were required to hold a portion of deposits as reserves. So Bank A might keep $10 and lend out the remaining $90 to someone buying a laptop. That person pays the laptop seller, who then deposits that $90 into Bank B. And Bank B keeps $9 and lends out $81. That $81 gets spent, deposited into Bank C, and Bank C keeps $8.10 and lends out around $72. And this process continues. By the end of it, that original $100 deposit can support close to $1,000 in new money circulating through the banking system. And the simplified formula people use to explain this is money supply equals the original deposit multiplied by 1 over the reserve ratio. So with a 10% reserve requirement, $100 can theoretically support about $1,000. Now here's the most important part. In March of 2020, the Federal Reserve eliminated reserve requirements entirely for most banks. There's no mandatory percentage anymore. Today, banks are not constrained by reserves in this way. They're constrained by capital requirements, liquidity rules, and whether there's demand for loans. So why does any of this actually matter to you? And the answer is because roughly 97% of the money in circulation today was created by commercial banks when they made loans. And only about 3% is physical cash printed by the government. That means most money in the economy is just debt. And the part that surprises people is if every loan in the economy were paid off tomorrow, most of the money supply would simply disappear. And this is why inflation, it's not just the government printing money. It's banks creating money faster than the economy is producing real goods and services. And when banks are loose with lending, like they were in the mid-2000s with subprime mortgages, the money supply expands rapidly and you start to see housing prices go up, stock prices go up, and everything seems to boom until it doesn't. We saw this in 2008 when borrowers started defaulting on those mortgages. The loans, which were assets on banks' balance sheets, suddenly lost value. Banks panicked and stopped lending. And when banks stop lending, money creation stops. And when loans get paid off or defaulted on and aren't replaced with new lending, money is also destroyed. And this is when you start to see the money supply contract, and it's also what a credit crunch is. And that's why 2008 was so brutal. The Federal Reserve tried to stabilize the system by cutting interest rates to zero and buying bonds to inject reserves. But they can't force banks to lend, and they can't force people to borrow money. So what do you do with this information? I'm not going to tell you to go into debt or to stop saving. That's not the point. The point is, understanding how money is actually created changes how you think about inflation, interest rates, and what safety really means. When the Fed raises interest rates, they're not doing it to punish you. They're trying to slow down money creation by making loans more expensive. And when your savings account is paying you 0.5% per year and inflation is 3%, you're losing purchasing power. Not because you're doing something wrong, because the system creates money through debt, and that dilutes the value of existing money. And this is why people who understand this eventually start focusing on real assets like real estate, stocks, or businesses instead of just putting cash in a savings account. Because assets can appreciate as the money supply expands, whereas cash just sits there and loses value. And you don't have to act on this today, but now you know how the game actually works, and that's worth more than most finance classes will ever teach you.